All right, good afternoon, everyone. Welcome to the Integrated Commerce in Practice. This will be my last lecture. Next week, I will come to give you a lecture on information system. Now, before we start, I'd like to have a few words on how you're going to prepare for your midterm and final exam. As you see in the announcement on Blackboard, for students, you are expected to do your homework, which means you need to come here for the lecture, or at least you need to watch your lecture recording at home. All of you are good ones, you come here. So just for those people who are not here, they have to listen to the lecture recordings to understand what we're talking about in the class. You also need to read your textbook, read those assigned readings, do the practice questions in order to prepare yourself for the final exam. I mentioned that because the last semester we have some issues with some students. I remember I was kind enough to offer the final consultation just 2 days before the final exam. And one student came to my office, asked some questions which shows he knows nothing about this course. So I asked him, did you come to class? He said, no. Did you listen to lecture recording? No. Did you read your textbook? No, I don't even have a textbook. Now we have this kind of students. I was very frustrated. Basically, I don't know how to teach this kind of student. As I said in the first class, accounting, all those commerce skills, you have to practice in order to understand and master those skills. Okay. So at some point of time, I don't know what's wrong with some universities or some students. Now you think you pay the fee, you deserve to get the degree. That's not like that. Like you buy coffee, get a coffee. In education, we actually try to help you to get the skills, get the knowledge to make you a qualified accountant or business person. You have to input your own efforts. So education is a joint work between students and the lecturers. Okay. So not a case we pay for that, you get it, no. And I also personally believe a degree from University of Queensland should only be given to people who deserve that. It's not something that anyone can buy with any amount of money. So please bear that in mind and make sure we are the best students from this university. All right, again, all of you are good students. You come here on time, you come to the lecture, I believe you also do your homework. So those comments are more for people who are not here and very likely they probably not listen to the lecture recording. So, okay, anyway. So remember, we have 4 classes in accounting. In the first class, we reviewed the basic accounting knowledge and accounting standards. In the second class, we examined accounting quality. We try to understand managers' incentives and the methods of accounting manipulation. We also learn how we can make accounting adjustments to undo those manipulations and to find the right accounting numbers that should be reported on the financial statements. In class 3, which is last week, we examine financial analysis, in which we use accounting ratios or financial ratios to assess companies' performance, including profitability, operating efficiency, and financial risk. Okay. So to prepare for your final midterm exam, you need to focus on these 3 lectures. You need to understand the accounting standards, accounting principles. You need to understand those very basic accounting knowledge and accounting equations that we discussed, the balance sheet, and how we can prepare the financial statements. You also need to understand the incentives and methods of accounting manipulation that we discussed in the class. Okay? So review your lecture notes that can help you to prepare for your final midterm exam. You also need to learn or understand how accounting adjustments can be done to find the right accounting numbers. And also you need to memorize some ratios that we discussed in the class. Now in your textbook, there are many more ratios. You don't have to memorize everything there. I know it's hard, but for those ratios that we discussed in the class, you do need to memorize some of those ratios. Okay? So that's what you need to do for the midterm exam. Okay? Is there any question you want to ask? And every week, I have a regular consultation on Wednesday afternoon from 2 to 4 p.m. If you have any questions regarding your learning, midterm, or final exam, please feel free to come to my office to ask me those questions. Or you can email me your questions if you can answer easily with an email. Okay, all right? So just remember, I'm here to help you, but you need to prepare yourself. You need to learn. Any question you want to ask? Okay. So today we discuss fundamental analysis. Now, when you do accounting analysis, when you examine accounting numbers, one important use of those analyses is to predict future performance and future share price. And that's a job for investors or share investors in particular. So in this class, we're going to introduce you to fundamental analysis. Why is it important? Can it help you to make money? We are going to discuss some valuation models that we can use to estimate a company's fundamental value, or sometimes we call it intrinsic value. There's a bit of change in the plan for today. So the last two bullet points, we don't cover that in this class. The reason is instead, we're going to replace that with some valuation questions. We're going to practice on those questions, and we're going to show you how we can work on those questions. The reason for that change is last semester, when we have the final exam, there are some valuation questions in the final exam, and the students have done terribly on those questions. So I think it could be a good idea to give some practice on those questions, okay? Instead of just talking about something you can learn from other sources or learn by yourself. Okay? For the behavioral finance and market efficiency, Barry is going to give you a lecture on behavioral finance towards the end of this semester, so you can get some lesson from him. So I think it's more important for us to have some practice questions on valuation to make sure if you see the same question in the final exam, you should be able to do it yourself. Right, so this class is based on some readings. One is a book called The Warren Buffett Way. Now this is an easy read. Okay? You can get the book from library, from other sources, but we're going to cover that. Another one is chapter 7 from this textbook, Business Analysis and Valuation. It's on Blackboard. You are required to go through this chapter and again make sure you understand everything that is discussed in this textbook, because this chapter talks about those valuation models that we will discuss in the class. Okay? So you don't have to read the book here, but you do need to read this chapter on Blackboard. All right? So we start with this gentleman called Warren Buffett. I'm sure many of you have heard of his name or learned about his story. Now, this is one of the most famous and the most successful investor in the world. For a few years, he has been ranked as the richest person in the world. Okay. Now, the reason why we are interested in Warren Buffett is unlike other people in the rich list who make the money through running a company or inheriting a large, amount of money from their parents, Warren Buffett basically made his way to the rich list through investing in the market. And that's something we can learn to make us rich. Now, certainly, that doesn't mean every one of you will become a next Warren Buffett, but at least that's something we can learn, okay, to make our life better. So here's a very brief introduction to Warren Buffett for people who don't know much about him. So at the age of 13, Warren Buffett worked as a newspaper delivery boy, making some pocket money by delivering newspapers to his neighbors. At the age of 15, he made his first investment in a second-hand pinball machine. Now, for people who don't know what a pinball machine is, this is like a kind of a game machine you place in pizza shops or there's barber shops. When people are waiting for the pizza or waiting for their haircut, they can play the game and lose money. And for the owner, that's a way you get money. Okay? It's kind of similar to casinos. Casino, you can treat a casino like a big or super big pinball machine, because people go to casinos to play and they lose money. The owner of the casino makes money. Okay? So the lesson we get from there is if you want to make money, probably it's not a good idea to gamble either in casinos or in the share market. Okay? Gambling, most likely, is going to make you lose money. So Warren Buffett went to Columbia University, and they obtained a Master of Economics degree. After that, he worked as a financial analyst for 2 years. Okay. Then at the age of 26, he started an investment partnership with just $100 out of his own pocket. So this partnership is some kind of a private equity funds nowadays in the market. So Warren Buffett basically worked as a fund manager. Okay. He's in charge of making investment decisions, which come to buy, which come to sell. He has shareholders or investors, those people who contribute capital to this partnership. 30 years later, at the age of 39, Warren Buffett cashed out or dissolved this partnership. He cashed out with $25 million. Now that was in 1960s. Okay. $25 million is a huge amount of money in those time, and also a big amount of money nowadays. Now typically, as a successful fund manager, with this amount of money, at the age of 39, it's time for you to retire and enjoy life. Okay. Now with that amount of money, Warren Buffett actually purchased the major ownership in Berkshire Hathaway and controlled this company. Now Berkshire Hathaway was his company. It's still existing nowadays. It's one of the largest companies nowadays. But in those days, Berkshire Hathaway was in trouble. It was a textile company making clothes. In the early 1960s, the whole clothing industry, textile industry in the US is declining or dying because the labor cost was very high. So companies have to move their operations or productions to Southeast Asia, where labor cost is lower. Berkshire Hathaway did not follow that move. So for a few years, company reported losses after losses. It was close to bankruptcy. Now, when a company is close to bankruptcy, what's going to happen to the share price is the price will keep going down to a very low level. So with that amount of money, Warren Buffett was able to control or become the largest shareholder of Berkshire Hathaway and control this company. Now you may want to ask, why do you want to buy a company close to bankruptcy? The reason is this is a public company or listed company. Now, as a public company, you have shares listed and traded in the stock exchange. And that allows you to issue new shares to get capital from new investors. Does that matter? Yes. Because for private companies, you're not allowed to issue shares to the general public. You can only sell your ownership to a limited number of private investors. For a public company, you can always issue shares to everyone in the market, as long as they're willing to buy your shares. So this finance option is very valuable to the companies. Okay. Now, after the next 40 years, Warren Buffett successfully transformed Berkshire Hathaway into an investment company. And nowadays, this is, as I said, is one of the largest companies in the world. Okay. In the time period, okay, the net worth of Berkshire Hathaway, you can think of this as equity, assets minus liabilities, that is available to the shareholders. So the net worth increased from $22 million to about $69 billion over 40 years' time. Now those numbers are quite different. If you translate that numbers into kind of a growth rate, that's about 22% a year, okay, in the 40-year time period. Now for most of us, 22% a year is not a big number, 0.22. But for fund managers or investors in the markets, 22% return, that's a very high number. Okay? Because in the market, in the US market, over the same time periods, the average annual return or annual percentage change in share price in the market is about 10%. And in any single year, okay, about 70% fund managers cannot give you a return higher than 10%. In other words, 70% of fund managers' return, professional fund managers' return, is lower than 10%. Now, Warren Buffett gave a return about 22% on average over 40 years' time. And also time periods is also important. As was said, in any single year, about 30% of fund managers can give a return higher than 10%, but there's no persistence in the performance. That means this year, I could be lucky, I get a return higher than 10%, but next year, it's very likely I will be in one of the 70% whose return is lower than the market, 10% return. Okay. So there's very few persistence in the markets. What Warren Buffett gives you is 22% return on average for 40 years. So it's those two numbers, 22% a year and 40 years, that made Warren Buffett the most successful investor in the world. Now, I emphasize this number a bit more, 22%. Okay. Now, when you buy or sell the shares, when you enter the markets, you always need to have some kind of expected returns. How much money I expect to make from my investments? I hope you can always remember this number, 22%, and that is return from Warren Buffett on average. Okay. If you expect anything higher than 22%, you probably have to ask yourself, how can I achieve that? How can I get a return higher than Warren Buffett's 22% return? Okay. Am I smarter than Warren Buffett, or do I have better luck than Warren Buffett? If not, then probably anything higher than 22% will be quite unreasonable. Okay. And that's important because one reason why a lot of our individual investors or small investors lose money in the share market is they have a very high expected returns. We want to be rich, and we want to be rich now. So invest $10,000 in the share markets today. I expect the amount of money double tomorrow, and at the end of the year become a millionaire. That kind of expectation is unreasonable, unsustainable, and they cannot be delivered in the share market. Okay. So we always say share market is actually a good place to make money slowly. Okay. If you get 10% return for a long time periods, you still make a very good returns and build up your wealth. But share market is also a good place to lose money quickly. If you want to gamble like casinos, you can lose money in just a few seconds. Okay. So bear that in mind. You need to have a long horizon. You also need to have a realistic and a reasonable expectation on your expected returns. So remember 22%. Another reason why I want to remember this number is from time to time, you will receive some calls from some salespeople of financial products. They're trying to convince you to buy the financial products, and many times they promise you with very high returns. Okay. We have seen this kind of financial fraud around the world. Okay. Some happened in Australia, in Queensland. Okay. Before financial crisis, a lot of this kind of fraudulent financial products was sold to pensioners in Queensland. Okay. So think about it, when you're 70 years old, you invest your lifelong savings into those fraudulent financial products. And then, a year later, you lost everything. How are you going to survive in the next 10 or 20 years after retirement? So you need to be careful. If someone offers you a product giving you a return higher than 22% a year, again, you have to ask, how could you achieve a return higher than Warren Buffett's return? Okay. So those are the reasons we need to bear in mind. Now, nowadays, Berkshire Hathaway controlled and owned a diversified portfolio of businesses, mainly in insurance companies. Okay. The major holdings include American Express, one of those credit card companies, Coca-Cola, okay, those beverage companies. Moody's is one of the 3 largest credit rating agencies in the market. Okay. Wells Fargo is one of the big 4 banks in the US, and BYD was a holding a few years ago. This is car manufacturers produce electric cars in China. So that is a simple introduction to Warren Buffett. This is the share price of Berkshire Hathaway starting from 1980s when the company was real estate stock exchange at the time. Price was very low, a few $100s per share. Okay. Let's say kind of early later of last year, the price was over $250,000 per share. And that number is $250,000 US per share. It's not Japanese yen or Korea won. Okay. So that is actually higher than my annual salary. Okay. Now you may ask, why do you keep the share price that high? So the high share price indicates the company has been very successful. Okay? But more importantly, you may want to ask, why don't you split your shares? Okay? Split your share means you can break your share, one share into, say, 1,000 shares. Okay? When you do this stock split, okay, your firm value doesn't change. You just split one share into 1,000 shares. Okay? So now after you split, the share price goes down from 250,000 to 250, because one old share is now worth 1,000 new shares. So new share price will be lower. Okay? Now at lower share price, more people like you and me could afford to buy the shares. And we know if more people can afford to buy or trade your shares, you get a better liquidity, and firm value could be increased by improved liquidity. Now Warren Buffett's idea is, no, we don't want to do that, because we want to select our own investors. Again, like for university, we want to choose our students. We only choose the best students in the market. Okay? For the company like Warren Buffett, okay, they want to choose their investors. So it's not like something everyone can buy. So we want to make sure investors have the same, okay, idea as us in terms of investments, and also importantly, same investment philosophies. Okay? So that's Berkshire A share. By the way, Berkshire does have B shares, and B share has much lower price, much affordable price. The difference between A share and B share is A share has voting rights, and B shares don't have voting rights. Voting rights allow investors to vote in the annual general meetings in deciding some important corporate decisions. Okay? And the voting rights themselves carry a premium. Okay, because that right allows you to influence companies' decisions. Okay, so that is the share price. Now, what we're interested in Warren Buffett is how he makes investment decisions. Okay, so we talk about his investment philosophy. One of the most important philosophies or arguments that he talks about a lot is this: buying stocks means buying a business. So in 1998, he said, "I buy businesses, not stocks. Businesses I would be willing to own forever." Now, this is kind of cold. You probably want to ask, what's the difference between a business and a stock? So what could be a business? We say businesses every day, all over the world. Okay? So a university could be a business. Okay? A coffee shop could be a business. Okay? And a large company could be a business. Okay. Now, some businesses are for profit, some are not for profit. And here we're talking about those for profit business. Okay. Now, suppose you are running a small business like a coffee shop. Okay. What's your objective? Why do you run this coffee shop? Very simple, right? You run the coffee shop because you want to make money. Okay? Now, the question is, how do you make money? Okay? Making money basically means, okay, you are going to make profits. And if you look at the income statements, okay, your profits is basically the difference between your revenues and expenses. To make sure you can make money or make profits, what you need to do is your revenues must be bigger than your expenses. Okay, that's the only way you can report a profit or make money in this business. And we also know how to make more money. That means you want to maximize your revenue, minimize your expenses. And we also know, okay, we have two businesses. One is big. The company gives you, say, 1 million profit every year. Another is a small one. The company gives you $1,000 profit every year. And we know the big one should be worth more than the small one. Okay? So to make it simple, if you're running a business or if you're the owner of a business, it's very likely your objective would be to maximize the profits. Okay? And to maximize profits, you want to maximize revenues and minimize your expenses. And we also know the value of that business basically is determined by how much profit or how much money you can make. The more profit you can make, that business will be worth more. So that is a simple idea, or you could call it a common sense for all those businesses in the world. Now come to a stock or shares. What is a stock? Or what is a share? When you buy a share, what do you get? Okay. Now in your finance textbook, what you learn is a stock or share gives you a partial ownership of a business. Okay. Now, in the early days, 200 or 300 years ago, we have those share ownership, okay, partnership. So when you buy the shares, you actually get a certificate in paper, okay, certify you are the owners of this company, you own how many shares of this company. Nowadays, we all have this electric trading system. We don't say that piece of certificate anymore. Okay? But in theory, at least in your textbooks, okay, the share owners, when you buy the shares, you become the owner of this company, even though you own a small fraction of the shares. Now, in that sense, if you buy the share, if you realize I'm the owner, then you probably need to understand, yes, okay, my value of the share, the value of my share would increase if company or this business value increase. And as we said just now, the value of a business is determined by how much profit this company will deliver in the future. The more profit the company can make, the more valuable the share would be. So it's a share price. The trouble here is many of us, in particular, many of small investors don't think that way. They think the share or the stock as a way to gamble in the market. They don't really understand what the business company is. What they care is the share price. If I buy $5 per share, then tomorrow share price increase from $5 to $6, I make a gain. That's all I care. I don't mind why the price change, how price will change, what's going on in the company. Okay? Now, essentially, they are gambling in the markets because even if they make money, they don't understand why they're making money. Okay? So in that sense, okay, I would suggest some shareholder to, if you want to gamble, a better place would be the casino. Because if you go to casino, you don't put down, say, $10,000 or $50,000 to gamble. Okay? You know that's risk. You play with small money. But in the name of investing in the share markets, many small investors are gambling with their lifelong savings. Okay? That is not a good idea. Okay? So later on, when you become your investor yourself, or if you have family members or friends or invest in share markets, you probably want to give them a lesson. Or give yourself a lesson. Are you gambling or are you investing? The difference here is in gambling, you don't know how to make predictions. Okay? You basically play with your luck. When investing, you do need to have a systematic way to make predictions. Okay? So that's a key difference. If you don't know how to make predictions, you are gambling. Okay? So the message here is quite clear. Okay? When you buy a share, you become an owner of that business. And you need to understand the value of a share is basically determined by how much money this company can produce. Okay? So that is the key message. In 1994, he said, all we want is to be in businesses that we understand, run by people whom we like, and priced attractively relative to their future prospects. Now, there are three key points here. Number one, you want to buy a business that you understand. Why you need to understand your business? Okay, a simple idea here is when you buy the shares, you become the owner of that business. As the owner, you do need to understand how company makes money. Okay? You understand its business model. You also need to get a sense whether the company's products will have high or low demand in the future. Okay? So that's something very important. And again, the phenomenon that we observe in the market is when people, individual investors, when people want to buy some small item like a computer, you do a lot of research. Okay? You want to compare different brands, you want to compare the price, you probably want to go to the shop to have a try on the computers. It just costs about a few $100s. When it comes to investing in share markets, It could be tens of thousands of dollars of investments. People make the decision in a few seconds. Usually I get a tip from my neighbor or from a financial analyst, so I buy some shares. Okay. We think hard. Okay. Is that really, are you really investing? Or again, are you just playing with your luck, making a wish? Okay. So that's something you need to understand. You need to understand the business. The next, run by people whom we like. Now, who are running the business? Who are running those companies? It's the managers. Managers are running the business. Okay. Then why do you need to like the managers as an investor? Now, if you think hard, okay, that's not too hard to understand. The reason is pretty clear. Once you buy the shares, okay, you hold the share, but the decision rights is given to the managers. Whether the company's value will increase or decrease, basically, is not controlled by yourself. It's controlled by the managers. If managers make the right decisions, make decisions increasing firm value, then your share price will increase. Okay? So that is what we say is the separation of ownership of control in the modern corporation world. Companies, in theory, are owned by shareholders, but are effectively controlled by the managers. And the firm value, okay, or how much money a company can produce in the long run or in the future, is determined by the manager's decisions. Now, in this case, okay, when you buy the shares, you must make sure that the managers are competent people. They are able to deliver good earnings, good returns in the future. Okay? And they are honest. They're not going to cheat you. Okay? And that's why you need to like those managers. You need to trust those managers. Last point is the price. The price of the business must be attractive relative to the future prospects. What that means is you want to buy at a low price, at a bargain price. You don't want to overpay. Okay? From time to time, we discuss the idea of a good company may not be a good investment, because a good company could be overpriced. The prices are too high. Okay? If you buy that high price, even though for that good company, if you overpay for that, the price will come down to fundamental value in the long run, and then you're going to lose your investments. Okay? So that is something you need to bear in mind. In 1980, he said, stocks are simple. Okay? For most of us, investing seems to be very, very complicated and difficult. But Warren Buffett said, stocks are simple. All you do is buy shares in a great business for less than the business is intrinsically worth, with the management of the highest integrity and ability. Then you own those shares forever. Okay. So again, a few things. Number one, you find an understandable and a good business. Okay. Number two, you buy at a low price, lower than the fundamental value or intrinsic value. And number three, managers are honest and competent. And number four, you must have a long horizon. You always own the shares for the long run. You are not influenced by the short-term price fluctuations or changes every day. Okay? Now this is very long, but summarize everything we talked about just now. Okay? So your goal as an investor should be simply to purchase at a rational price a part interest in an easily understood business whose earnings are virtually certain to be materially higher 5, 10, 20 years from now. Okay? So that tells you what kind of company you need to buy. Over time, you will find only a few companies that meet those standards. So when you see one that qualifies, you should buy a meaningful amount of stock. Okay? So very simple idea. Find a good business, buy at a low price, hold forever. Okay? And in the markets, you have thousands of companies. In Australia, we have over 2,000 companies in the stock exchange. But most of those companies are not worth buying. Only a few companies can meet those criteria. And once you find that one or two of them, you should buy a lot of shares. And this is what we call focused portfolio or concentrated portfolio. Again, it's very different from what you learn in your finance textbook. In your finance textbook, you should be diversifying your holdings. Okay? You should buy not just buy 1 or 2 shares of companies, you should buy a large number of companies, or even better, you should hold the market index, okay, that every company in the market. Now, why do we have different ideas from your finance textbook and then this one from the Warren Buffett? Why the finance textbook advises you to diversify your portfolios? And why Warren Buffett asks you to concentrate your portfolios on a few stocks? What's the reason for these 2 different ideas? Okay, let's start with your finance textbook. If you still remember what you learned in the portfolio theory, why do you want to diversify? We want to reduce the risk. What kind of risk? By diversification, we can reduce the idiosyncratic risk or firm-specific risk. So in a risk, some risks are called market risk that affect every company in the market. No matter how big your portfolio is, you're subject to that kind of risk. That risk usually is caused by economic fluctuations or systematic changes in the economy or in the government or those kind of political risk factors. Other risks could be firm-specific. Now, for example, I have a good product, so my earnings increase. Or my CEO just died yesterday, so my share price crashed. And that kind of risk is specific to a particular firm. Now, when you diversify, that means you have different companies in your portfolio, but then the firm-specific risk could be offsetting each other. Now, for example, okay, I'm, say, Qantas. Now, oil price change is a risk for me, okay, because my operation relies on the fuel, and the fuel cost is a significant component of my expenses. When the fuel price increase or oil price increase, that's bad news to me, because high oil price means high fuel expenses, then low earnings. Now, if you think about British Petrol, okay, a company producing these oils, the high oil price is good news for BP because high oil price means they can sell the oil at a high price, they get more revenues and more earnings. Okay? So the oil price change is one kind of idiosyncratic risk or firm-specific risk for either BP or Qantas. Now, suppose you buy both companies or have them both in your portfolio. Then when oil price increase, that's good news for BP, but bad news for Qantas. When you combine them together, this news could offset each other. So your portfolio's earnings will be more stable or less subject to the changing oil prices. That's a simple idea of diversification. More importantly, in your finance textbook, what we assume is market efficiency, price or right. Under that assumption, every stock can be summarized by 2 parameters. Number 1 is expected returns. Number 2 is your risk. And we have this CPM model deriving from that assumption. So in this world, okay, prices are correct in the sense that okay, people price your company based on your risk. If you have high risk, you give us high returns. If you have a low risk, you give us low returns. And that has done perfectly. There's no mispricing in the market. Now, in that case, for investors, you don't have to spend time digging out which company has been mispriced. There's no mispricing. Every company is priced properly. What you do as an investor is you want to hold a well-diversified portfolio. Okay? So to diversify away those idiosyncratic risks. So you only take those market risk or systematic risk. And based on your own risk function or risk attitude, you decide how much risk you want to take. If you want to take more risk, then you invest more into risky assets like shares or bonds. If you are very risk averse, okay, you want to invest less and invest into these risky assets, but put more money into bank account. Okay? So that's a simple idea from this financial textbook, okay, asking investors to diversify. That our assumption is prices are correct, market is efficient. In Warren Buffett's way, or in Warren Buffett's word, do you think Warren Buffett believes every company's price is correct? No. Okay. he could argue, most of company price probably is correct, but still, you find some company that has been undervalued. Okay? A rational price basically here means a price lower than its fundamental value. Okay? So you have a great business, but if the price is too low, lower than fundamental value, and that's the time you should buy this company, okay, and hold it forever. Okay? And at the same time, remember, as he said just now, okay, you will find only a few companies meet those standards, in the sense that not every company price is wrong. Most of company price probably are still efficient or correct. Only a few companies' price could be wrong. And then you need to focus on those a few undervalued good companies. Okay? So that's the difference between Warren Buffett's philosophy and what you learn in finance textbook. The key difference is that we have different assumptions about the mispricing or market efficiency in the market. Now to summarize, here are a few key points in Warren Buffett's investment philosophy. Number one, you should be able to understand the business. You need to understand how a company makes money. And in this sense, you need to examine corporate strategy, you need to examine company's products, okay? And you also need to understand company's performance as well. So content analysis and financial analysis that we discussed in previous 2 weeks could help you. You must have a competent and honest management teams. Okay? So again, if managers are competent, their performance should be better than the peer firms, or should be improving over time. You can learn that from financial analysis by examining its ratios over time and relative to those competitors. Managers should be honest in the sense that information they disclosed should be reliable. Again, content analysis can help you to make this judgment. If an evidence of a manipulation or misreporting, then that's a question whether managers are honest or not. Company must have a strong earnings record. Okay? As we said, your value is determined by how much money or how much profit you can produce in the future. Predicting future is very difficult. Okay? One way to help you to make this better prediction is look at what happened in the past. If a company has a successful history or track record in delivering high earnings, it's more likely company will continue to give you high earnings, even though there's no guarantee, but you have better chance than companies that don't give you good earnings in the past. Okay? So that's something we need to bear in mind. And again, some people question that point. Okay? Now for Warren Buffett, he never invested in the technology companies, because for most of technology companies, they don't report profits, especially those start-up, high-priced technology companies. They report losses year after year, quarter after quarter. Warren Buffett shied away from these companies. And at one point of time, in particular in late 1990s, when we had an internet bubble in the US, okay, his performance was lower than the NASDAQ index. Many fund managers who invest in these technology companies give better performance than Warren Buffett did. So at that point of time, he was under huge amount of pressure, and people laughed at him. So you are too old to understand the new economy, new technology. But then, in 2000, 2001, when the internet bubble bursted, the NASDAQ lost more than 80% of its value in just 1 or 2 years' time. People realized, okay, Warren Buffett was right. Okay, companies still need to be supported by earnings. Okay, any business, okay, if you want to survive, if you want to do well, you need to deliver earnings and profits to shareholders. Margin of safety. You want to buy at a price lower than its fundamental value. Okay? So to give you some kind of a margin of safety, focus the portfolio. You don't have to buy every company in the markets. Most companies are not worth buying. You only buy those a few good companies that are undervalued. Okay? You don't buy better companies. You only focus on good companies, have low price. Long-term investments. Okay? Peter said we want to hold the shares forever. The last one is the discipline. Okay, once said, to be a successful investor, you don't need a PhD degree in finance or mathematics, but you do need to have some discipline. Okay? Discipline in the sense that you need to follow this strategy throughout your investment process. Now, when you look back, most of this seems to be common sense. Okay? It's not that hard to understand. But again, in the market, okay, A lot of investors don't follow that. In particular, a lot of small investors lose money in share markets. You may want to ask, why don't they follow Warren Buffett's way to make high returns in the market, 22% a year? Now, if you think hard, many of these are not that easy to implement. Okay? Some of these probably are against our human nature. Now, for example, to understand a business, that requires you to understand what's going on in the company, ask you to examine company's corporate strategy, industry competition, read its annual reports. Okay? Many people don't want to do that. Okay? And if you want to examine margin of safety, you want to buy a price lower than intrinsic value. You can observe the price in the market easily, but how do you know what the intrinsic value is? To get this intrinsic value or fundamental value, you have to do valuation. Okay? And that's something we're going to talk about in the next half an hour. Okay? And that valuation is not an easy task you can do in a few minutes. Okay? In my another course at postgraduate program, okay, we have one course on fundamental analysis, and students spend weeks on doing fundamental analysis for one company. That could be time consuming. That could be a lot of work involved. Okay? And the long-term investments, you buy the shares, hold for a long run. Again, for many of us, that is boring. Okay? Because you buy a share, hold for a long run, there's no fun at all. Most of us like excitement. Most of us like to be rich quickly. We don't want to wait for too long. As we said just now, we want to be rich, and we want to be rich now. Okay? So because of lack of patience, because of a lack of this excitement from these long-term investments, I guess that's probably the reason why many investors don't follow Warren Buffett's strategy, even though it's quite intuitive and simple to understand. Okay? So what do we do? Okay. Next, these are the questions summarized in that book called The Warren Buffett Way. Okay. So before you invest in the share markets, before you buy any company, those are the questions you need to ask yourself. Okay. You need to get the answer to all those questions. First one is about the business tenets. Is the business simple and understandable? Does the business have a favorable long-term prospects? So again, the key message here is we understand we buy the shares, you become an owner of the business. So you need to understand its business. You need to understand its products. Second, about the management tenets. A manager is honest and competent. Is management candid to its shareholders? Okay. Now about financial analysis. What was the financial strength and weakness of the company? Is there any financial risk for the company? Okay. And they have value tenets. What is the intrinsic value of the company? Is the stock price priced at a discount relative to its values? Okay. So that are the questions every investor needs to understand, need to get an answer before they buy the shares. Okay. Now in fundamental analysis, or what we learned in past few weeks, okay, that can help us to answer those questions. Okay. So now you can read financial statements to understand what's going on in the company. You can assess its performance to understand the company's business model. Okay. Okay. You can use accounting analysis to assess whether companies are honest or managers are honest. You can use financial analysis, okay, or ratios to assess company's performance or financial strengths and weakness. And that also is a way to assess whether managers are competent or not. Okay. You can use ratio analysis to assess company's financial risk. Okay, whether the company have enough ability to pay the debt or short-term liabilities or not. Okay. In this class, we're going to discuss how we estimate fundamental value. Okay. Then you can compare the fundamental value estimates with the share price, and you can judge whether the price is too high or too low. Then you can make your investment decisions. Okay. So that is what we do in fundamental analysis. And again, in fundamental analysis, we don't look at price change every day. Okay. What you do is spend time reading newspapers, reading annual reports, making your own analysis, doing your calculations. And once you get your intrinsic value, then compare that with the share price. Your price are too high, you sell. Your price are too low, you buy. Okay. That's a very simple strategy for investors. Okay. If you go to Warren Buffett's office, I guess many of you will be surprised because unlike our usual perception of successful investors, Now, you see, fund managers, they could have several screens in front of them during all kinds of price changes. In Warren Buffett's office, that's an old computer. Most of the time, it's shut down. Okay. Warren Buffett spends most of his time reading newspapers or any reports. Yeah. And that's the job for most of us fundamental investors or fundamental analysts. Right? Now, if you are interested in Warren Buffett, there are a few books on Warren Buffett. Okay. You can read any of them. They are very similar because they're all about the same person. Okay. If you have time, take a look at Berkshire Hathaway's annual reports on this website. And if you go to this website, I'm sure again you will be a bit surprised. Unlike any other company's website where you see colors, pictures, or videos, this website is just as simple as my slides here. You see some bulletin points, you see black and white, there's no other color. Okay. So again, simple to understand, and simple is always beautiful in investing. Right? So next, we are going to do the hard work. We are going to talk about valuation models. Okay? You do need valuation models to estimate company fundamental value. Now again, good news is for accounting and finance students, you probably have learned these models from other courses. Okay? For accounting students, when you learn to estimate fair value for some assets, you probably learn this discounted cash flow approach. That's exactly what we're going to talk about here. For finance students, you learn those discounted cash flow models or discounted dividend model. That's what we're going to talk about here as well. Okay, so we're going to quickly go through that. So in terms of valuation, broadly speaking, you have two approaches to do that. The first one is using discounted cash flow approach to directly compute the fundamental value for the equity or for the firm. Under this umbrella, you have a discounted dividend model, discounted free cash flow model, and a discounted normal earnings model. Okay. The second approach is called a relative valuation approach. In this case, you compare two comparable companies' financial ratios or price multiples, like P ratio, PB ratio, and then you use one company's price multiple as a benchmark to value the other company. Okay. We're going to show some example later on. Okay. Now, a simple idea underlying discounted cash flow approach is this. We think a company is basically a cash cow or cash machine. Every year, this cash machine will give you a cash flow. And also to make it simple, we assume all the cash flow comes at the end of the year. So cash flow 1 comes at the end of year 1, and cash flow 2 comes at the end of year 2, etc. Now, when you have this setup, it's very easy to understand. The value of this machine basically is the present value of all the future cash flows. In other words, if you discount those future cash flows back to time 0, add them up, you get a valuation. Okay? And that is also the idea we'll talk about just now. The value of our business is determined by how much money it can produce in the future. In this case, we talk about cash flow as our measure of profits. Now we have more profits or more cash flows in the future, your value will be higher. So that's a very simple idea of a discounted cash flow approach. Now in this model, you need to estimate forecast future cash flows. You need to estimate the discount rate. Okay? Now the first model we look at is a discounted dividend model. Now here we'll talk about dividend as a way or as a measure of our cash flow. Okay? So in this model, the numerator is a dividend you receive from the company. The denominator is the cost of equity, or the discount rate we use is cost of equity. Okay? An advantage of this model is dividends represents the real cash flow available to shareholders. Now, because if you buy, say, 100 shares of Tesla, yes, in theory, you're the shareholder, but in effect, you have no control of the company at all. Okay? Because your 100 shares is just too small. Okay? Now, in this case, what you get from your investments is the dividends. If Tesla pays some dividends, you get that. If Tesla pays nothing, you get nothing too. Okay? So that represents a real cash flow available to shareholders. And for large companies like Tesla, okay, the cash dividends tend to be quite stable. In most of Australian companies, we have relatively stable payout ratio. The payout ratio is your dividend divided by your earnings. So for some like Tesla, that payout ratio is relatively stable at 70%. So if I report $1 earnings, I give 70 cents as cash dividend to shareholders. and that is relatively stable over time. Stable means it's relatively easy for you to predict or forecast the future dividends from these models. Same time, you have difficulty to apply the model to some companies that don't pay dividends. Okay? A large number of companies in the world don't pay dividends. If that happens, again, it's hard to apply the model because this number will be zero for a number of years in the future. Okay? Then get a very low valuation. Okay? Number two is nowadays another way to give cash back to shareholder is share purchase. Okay? Now, share purchase happens when company use cash to buy the shares from the public market or secondary market and retire the shares. After share repurchase, the number of shares outstanding will be smaller. Okay? The share price will go up. Okay? Now, effectively, for shareholders, okay, now your shareholding is worth more because of this increase in share price after the share buyback. If you want to get cash, what you can do is sell a few of your shares. So equivalently, that means you can also get the cash from the company. Now, why that is more attractive? One consideration is tax. In some markets like US, the tax on dividends is higher than the tax on the capital gain. Capital gain coming from the price change or price increase. Okay? So if I get dividends, typically that's treated as my income. So I have to pay my marginal tax and the income tax on that. If you have a marginal tax rate of 40%, then you pay 40% tax on your dividends. But if you come to buy back the shares, and share price increase, okay, and then if that happens, you sell the shares, you also make the same amount of cash, but the tax on that amount of cash or capital gain usually kept at 15%. Okay? So you pay less tax on that capital gain. And that's the reason why many investors and companies prefer share purchase. Second reason is, again, for some strange reason, when companies start paying dividends, that become a commitment. When people expect you to keep making cash dividend payments every year. Okay? And for some company, now that could be a burden because this year supposed to have a lot of cash, I can pay dividends easily. But next year, if I run out of earnings or run out of cash, I cannot make the payments. Okay? But a share purchase can be relatively flexible. If you have more earnings or more cash, you can buy back the shares. If you don't have earnings this year, you don't have to buy back the shares. So that flexibility gives the managers, motivated managers to prefer share purchase more than the cash dividends. Now, we say company has share repurchase, you have to make some adjustments. Okay? In this case, your dividends should include both cash dividends and the amount of money company spend on share purchase. Okay? So you have to make that a bit of adjustments to use the model. Okay? Now, if we can make a further assumption, if dividends can grow at constant rate of G, they have this constant growth rate model, or sometimes called Goldilocks model. So price today, or value today, is given by next year's dividends, okay, divided by R minus G. R is the discount rate or cost of equity, and G is the growth rate in the dividends. Okay? So now remember, the model is only valid when R is bigger than G. So R is bigger than G, that means make sure the price is positive. If R is smaller than G, this amount will be negative, they get negative price, which doesn't make sense. This tells you, remember, this model assumes your dividend will grow at G forever. So your choice of G must be reasonable. Now, in the long run, most of companies could not survive in the market, let alone keep growing. Okay? So your G normally should be something like a GDP growth rate, 3 or 4% a year. Okay? You're assuming basically company can survive and grow with the overall economy, or kind of an industrial growth rate if you have that number for you. Okay? Don't expect a G of 20% or 50%. Okay? No company can grow at that rate forever. You do see some companies have very high growth rate, even double their earnings or dividends in 1 or 2 years' time. But remember, we're talking about the long-run growth rate. No company can take that kind of growth rate in the long run. Now, think about that. If you look at those technology companies' valuations, or even nowadays, okay, some kind of unicorn company in the market. They get a very high share price. If you use model, you can work out based on the price today you observe, based on the dividends they pay, okay, you can work out their growth rate. Okay? And some company has very high growth rate expectations. Okay? And that kind of growth rate expectation usually is not sustainable and reasonable. Okay? This model also tells us, it's very simple, but tells us some important things. Now, your P is what you observe today. The price today you observe is basically driven by two factors. Number one, your discount rate. Number two is your growth rate. Okay? Because once you have a growth rate, you can work out your dividends next year, or D1. Okay? So we have a high growth rate, you get a high price. Okay? We have a lower discount rate, you're going to get a high price as well. So two types of company will give you high valuation or high share price. Company with high growth, okay. Company with low discount rate. Low discount usually means low risk. We have low risk, we have high growth, you get very high share price. Now for investor, that tells you where you should look for companies that give you high returns. You look for company with high growth rate, company with low risk. And it also tells us why price changes in the market. Okay? Whenever there's change in the growth rate, or there's a change in the discount rate or the risk, okay, the share price will change. Okay? Now, sometimes we'll call this change. To give examples, think about this earning announcements. Okay? Now, when earning announcement happens, company report earnings, suppose that is higher than market expectations. And we know we gave high earnings, that's good news. Price should increase. But exactly why price should increase and by how much? If you examine the model, you understand it better. We have high earnings, everything else equal, it's very likely okay, you're going to have a higher than expected growth rate. Your G will be higher than expected. Okay? When you have high G, your price should increase. Okay? That's one direct channel. Number two, when you have higher earnings, everything else equal, that means you have more earnings to pay your interest expense to reduce your debt, then your default risk should be lower. Now, as long as you believe the default risk is priced or affecting your cost of equity, then you have lower default rate or lower risk, your cost of equity should be lower. Again, when R is lower, your price should be higher. So that tells you when company deliver good news or good earnings news, you're going to have a high growth rate, lower risk, or low discount rate. That's why price should increase. Okay. In that way, you can also think about other announcements from the companies. For some companies, their earning announcements, even though they report high earnings, okay, could lead to a lower price. Okay. Now, why does that happen? It could be the case that people don't expect your growth rate to be sustainable, or your growth could be risky. Okay. Now, growth typically comes from companies' new products, new strategy, or new breakthrough. And the growth usually means a bit of high risk. Okay. And that's the reason why we say, if you look at technology companies, okay, these young companies, startup companies that have very high growth rate, they can double or increase their earning at a high margin in short time periods. But those companies usually have high risk relative to large companies. If you look at large companies like Telstra, they don't have a very high growth rate. Okay? If they increase their earnings by 10% or even 5%, that's good enough. But those companies also have low risk. Okay? So that's a bit of trade-off in those two parameters. Okay? So this is a constant growth rate model. You need to remember this model for your exam. Okay? Here's a simple example. Now, sometimes companies don't have a constant growth. Okay. They could have a high growth for a few years. Then, in the long run, you can assume the growth will be stable and constant. If that happens, we can use a multiple growth rate model. So first, you forecast or calculate dividends in the first few years under high growth rate. Then after some point of time, you assume the growth will be constant. Okay. Then you compute those terminal value coming from the years with constant growth rate. And then you add them up, okay, you get the valuation. Now here's an example. Suppose the quarter dividends is $1 per share, which is just paid yesterday. Okay? That happened yesterday, so don't affect your future. And this number, the dividends, is expected to grow at 12% per year for 5 years. So the first 5 years, you have high growth rate, 12% a year. After that, the new growth rate is expected to be a constant 6% a year. Okay? The required rate of return or cost of equity is 10%. So how do you estimate the firm value? Now what we do is we work out the dividends. Okay? So dividends you paid yesterday is $1 per share. So remember, in the first 5 years, this number will increase by 12% every year. So in year 1, your first dividends will be $1.12, 12% increase relative to last one. Then another 12% increase to $1.25 in year 2, and keep going up until you get year 5, $1.76. After year 5, your new growth rate will be 6%. So your D6 will be D5 times 1.06. Okay? And we know starting from year 6, your growth rate will be constant at 6% a year. Under that assumption, you can use the constant growth rate model to find the terminal value. Okay? This is the terminal value, not the television. Okay? So this is D6. Okay? Next is dividends divided by R minus G. R is 10% cost of equity. G is 6% the growth rate. Okay? Now next is this terminal value basically summarizes the present value of all the future dividends beyond year 6 onwards, okay, and discount them, okay, and at the end of year 5. Okay. Now next step is you need to discount D1, D2, D3, D4, D5 back to time 0. You also need to discount terminal value back to time 0. Add them up, you get this valuation. Okay. So for the first 5 dividends, after discounting, and the sum of the present value is $5.26. The terminal value has the present value of about $29. Add them up, you get $34 for this company. So that's how we estimate the fundamental value. Now, there's a small thing I need to point out. When you do discounting or find the present value for these cash flows, for D1, we know you discount this one for 1 year. So that's $1.12 divided by 1.1. For D2, you discount for 2 years. So the denominator will be 1.1 raised to the power of 5. You keep going that. Now come to terminal value. Should you discount this terminal value for 5 years or 6 years? Yes, the answer is 5 years. Why is 5 years? Why not 6 years? Because we use D6 here, so your terminal value calculation is a time at the end of year 5. It's always 1 year before your D6. Okay? To say this clearly, look at the question here. Okay? So get a valuation time 0. The dividend we use is D1. That will come a year after this point of time, or come at the end of year 1. So there's always a 1 year time lag between the dividends and your valuation. You get a value 1 year before you receive the dividends. Okay? In this case, we use D6. That will come at the end of year 6. So your terminal value will be calculated at the time of end of year 5, 1 year before D6. That's a small thing, but that decides if you get the right answer or not. Okay? Now, again, another issue with this one is look at these 2 components. Okay? For the first 5 years, you get a present value of $5.26. For the terminal value, you get a present value of $29. So what you see here is a large chunk of that present value or share price is driven by the terminal value. The problem here is all the numbers are based on your forecast. And we have a more reliable forecast for the short run. We're probably more confident in saying what's going to happen next year or in the next 2 years. We don't really know what's going to happen after year 5 in the long run. But this valuation approach gives you a large weight on something we don't have much confidence on. That's the terminal value. So that is a limitation of this discounted dividend model. they put too much weight on the terminal value, and we don't have much confidence on the estimation of this terminal value. It is based on your long-term forecast. We have no idea what's going to happen in the long run. Okay? So when you use this model, very likely you have to do some sensitivity analysis. You have to think or ask yourself, okay, if your long-term growth rate is slightly different, how does that affect your valuation? Okay? So that's something you need to bear in mind. Any question of this here? Now this is the discount dividend model, but this approach we show in this example can be applied to any other models. Okay? So for all other models, whether free cash flow model or abnormal earning model, we're going to talk about later on, we always make assumption that you have different growth rate for the first few years. Then after a point of time, your growth rate will be constant. Okay? Then we always use constant growth rate model to find your terminal value. Then we discount the cash flow back to time zero, add them up, get a valuation. So this is the approach you need to understand as well. Okay. Next one is discounted free cash flow models. Now, the issue here is the simple idea of free cash flow is after this year's operation, I have this amount of cash flow from operations. Okay. But I know I cannot give all the cash flow from operation back to shareholders as dividends because I need to use some cash to replace some assets that are too old, to replace some inventories, okay, to invest in some working capitals. After those capital expenditure and investments in working capitals, and what's left is called free cash flow. So again, in theory, that amount of free cash flow should be freely available for the shareholders, so they are exactly the same as dividends. Okay? But the company may choose to return them within the company. So the simple idea here is the free cash flow is the net income you get, added back depreciation and deferred tax. Those are not real cash outflows. Those are accrual adjustments. Okay? You minus capital expenditure. That is your investments in those long-term assets like PPE. You buy a new machine, you replace your old warehouse. That goes here. Okay? Then minus increase in working capital. So you invest more into inventories, into accounts receivables. So that goes there. And then you add back increase in debt. Okay? So if you issue new debt, that amount of money, again, is freely available to the equity holders or to the company to use. So this gives you one definition of free cash flow to equity. Okay? Now we can, as I said, in theory, this amount of money or free cash flow is available to shareholders. If company like, they can just give all of this free cash flow back to shareholders as dividends. Okay? So you can also discount this free cash flow to equity year by year, add them up, you get the firm value. Okay? Now you do this discounting, again we use cost of equity to discount free cash flow to equity holders. Okay? So you also need to estimate discount rate, you need to estimate free cash flows and terminal values. Okay? You estimate free cash flow in detail for a number of years under assumption of a different growth rate in the first few years. Then after a point of time, okay, 5 years or 10 years, you assume free cash flow will be constant in the long run. Okay? Then you use this constant growth rate model to find terminal value. Then add them up, you get a valuation. Okay? So again, this model works best for cash cow companies. Those companies producing regular positive free cash flow year after year. Again, like Telstra, okay? Or some kind of those banks. Okay? The cash flow relatively stable, easy to forecast. But if you look at growth companies, this company usually have negative free cash flows. Then again, this model does not work very well. Okay? And that's the reason why we have different models. Every model has some limitations. That's why you need to choose the best model given your company. Well, we're going to spend a bit of time to look at this new model called discounted abnormal earnings model. Okay? This is a bit long, but it has a lot of advantage. We're going to talk about it on. So we start with this clean surplus equation. Okay? Again, in accounting, this is coming from your final adjustments you make when you close all the accounts. Okay? So this question tells you the equity, the book value of equity at the end of the year, that equals your beginning equity plus return earnings. Return earning basically is your net income minus dividends. So clean surplus equation holds if there's only change in equity is return earnings. That means company did not issue new shares or buy back the shares. Okay? Company did not change its reserve. So only change in equity is retained earnings. And retained earnings is net income divided by dividends. Okay? So once you have this clean surplus equation, you can rearrange, move the dividend to the left-hand side, move BVE1 to the right-hand side, you have this dividends equation. So in other words, dividends also equals your beginning equity plus net income minus any equity. That also gives a way to calculate the dividends. Now if you plug this dividend equation into the discounted dividend model, and you work through step by step, after some mathematical operations and manipulations, you get this very long equation. Okay? The detailed step of this is given in your textbook, okay, on Blackboard. So this equation tells you the company's price today, okay, is driven by two components. The first one is the beginning at book value of equity, okay, which you can observe on the company's balance sheet. Okay. Second component is what we call the present value of future abnormal earnings. The numerator in these components are called abnormal earnings. Okay. That is the net income minus cost of equity times beginning equity. Okay. Now, the second component here, the beginning equity times return cost of equity, this gives you the dollar amount of cost of equity. The idea here is, now for shareholders, at the beginning of the year, I give you this amount of equity for your operation. Okay? At the end of the year, you give me this amount of profits. And the profits comes from your operations, that's your revenue minus your cost of goods sold, minus operating expenses, minus tax, minus interest expense. And so what left is your profit. In this calculation, you consider almost every stakeholder except one. So your cost of goods sold is paid to your creditors or suppliers. Okay? Your operating expense is paid to your employees, paid to the other suppliers. Okay? And then your tax is paid to the government. Your interest expense is paid to the banks or your creditors. Okay? But in this calculation, you forget equity holders. When I provide this amount of equity to your company, I also incur some kind of cost. Okay? Like when you borrow money from bank will charge you the interest rate and you pay interest expense. When you borrow money from equity holders, okay, even though there's no contract saying you have to pay, say, 5% or 10% cost of equity, but you need to consider that cost. Okay? So if you use cost of equity, suppose 10% times the beginning equity, that tells you the dollar amount of the cost of equity. If you take that out from your net income, and what's left is called abnormal earning or residual income, okay, which captures the value created from company's operation after paying all the costs and expenses. Okay. It's kind of similar to the idea of economic value added, but the calculation is very different. Okay. EVA has more complicated calculations. Okay. This is more kind of intuitive and simple to us. Okay. So remember, this abnormal earning captures the value created from company's operation after taking into account all the expenses and all the costs, including cost of capital, which also include the cost of debt and the cost of equity. Okay. So this equation also tells us, okay, whether price is higher or lower than your book value of equity. That depends on whether they can produce positive or negative abnormal earnings in the future, because abnormal earnings is the difference between the two numbers. So this could be positive, this could be negative. If your future normal earning is positive, that means you get more value from your operation. If your normal earning in the future is negative, your operation actually is destroying shareholder value. Okay? So deviation from price price from book value of equity depends on company's ability to produce abnormal earnings. Now to understand that more, we can do a bit of a transformation. If you divide both net income and the second components by BVE 0, beginning equity, okay, the net income divided by book value of equity is ROE, return on equity. Okay. The second component, you cancel out this BVE, they just left cost of equity, and you can take BVE out of this bracket. Okay. So what this tells you is if your ROE return on equity is higher than cost of equity, okay, then your normal earning will be positive. Okay. If your ROE is lower than your cost of equity, your normal earning will be negative. Okay. So which implies, okay, if your ROE is higher than RE, cost of equity, or not even positive, that just implies company has a positive NPV projects. Okay. A simple way to understand this is we learn capital budgeting. Okay. So you know whether you have positive NPV or negative NPV, many times depends on a simple comparison between IRR, internal rate of return, and your cost of equity or cost of capital. In this case, you can think about ROE as a simple measure of IAA, internal rate of return. If that internal rate of return or your return from your investing in own equity from your own operation is higher than cost of equity, then you make a gain, and then this project must have positive NPV or net present value, okay, and then firm value will increase. Okay. So that is very consistent with what you learn in your corporate finance textbook. Okay. It's also similar to what we discussed last week. Okay. When company borrow money from the banks or using leverage, whether that can increase or decrease ROE depends on if your operating ROA is higher or lower than your cost of our debt. If you borrow money from the bank at a cost, say 5% per dollar, okay, and you invest in your own operation, you get a return, say ROA is 10% higher than that. In that case, you're going to create a value for shareholders, your ROE will be higher. Okay. If not, your ROE will be lower. Same story here. When company borrow money from shareholders to invest in their own operation, in the end of the year, okay, the return is ROE. If the return is higher than cost of equity, you are creating value for your shareholders. The whole company is a positive NPV project. If that ROE is lower than cost of equity, you are destroying shareholder values. The whole company is a negative NPV project. Okay. So that's nothing strange here. It's quite consistent with the corporate finance theory. Positive NPV projects increase firm value. Okay. Now again, if you make some assumptions, excuse me, if both ROE and the cost of equity are constant, and the book value of equity grows at a constant rate of G, you have this equation here. Okay. This is expressed as a ratio, but you can move B0. This B0 just is the book value of equity 0 to the right-hand side. That gives you a valuation of P. Okay. What this tells you is the price of a company basically driven by three components. First one, ROE. When you have high ROE, you are going to have a higher price. Okay. Second one is, again, the cost of equity. The third one is the growth rate. Okay. Consistent with the discount dividend model, we have high growth rate, we have a lower cost of equity or lower risk, you're going to have high valuation. So the additional insight from this model is the ROE. We have high ROE, you get a high valuation. Now, as we'll talk about last week, how do you get a high ROE? You think about the two-point equation, right? You have three components: profit margin, term ratios, and the leverage. To increase ROE, what a company should do is increase your profit margin, increase your term ratios, okay, or increase your operating efficiency, make more efficient use of your assets. Then think about your leverage. If your operating ROA is higher than the cost of debt, you should use or increase your leverage, okay, to increase your ROE. So those are things we look at. Again, if you want to ask more, okay, ROE can be increased in this way, but how about growth rate? How do you achieve high growth rate? What we said just now is think about new products, think about new markets, think about more competitive strengths that can help you to get more market share from competitors. Okay. And then how about your cost of equity? As we said just now, cost of equity is driven by your risk. You should think about reduce your risk. Make sure your operation is stable. Make sure your disclosure is transparent so people have less estimation errors or estimation risk. Because when people don't know what's going on in your company, they always think about the worst. So if that happens, you get a discount. It will be better if you disclose transparently, tell people what's going on, then people have a more accurate estimation of your operations or prediction of future performance. They give you a better valuation. So those are the ways you can use to manage your risk. To reduce your risk, you get high valuation. So in the end, fundamentally, your company's price should be driven by your fundamental operations, your risk management, your operating efficiency, your operating profitability. and your disclosure as well. Okay. So that is what we say, fundamental analysis basically asks you to link company's share price to fundamental operations. Now, furthermore, if you can assume ROE, cost of equity, and the dividend payout ratio, that is dividend divided by earnings, are constant. Once you get the three assumptions, we can show that BVE, your equity, your net income, your dividends, and abnormal earnings will all grow at the same rate. And this growth rate is ROE times 1 minus capital payout ratio. Now, in some of textbooks, this growth rate is called sustainable growth rate. This is a growth rate a company can maintain and sustain without issuing new equity or new debt. You are basically growing based on your internal generated cash flows. Okay. Under these assumptions, discounted dividend model will give you exactly the same valuation as discounted abnormal earning model. Okay, so that is something you can show mathematically after class. Now, to give you a numerical example, and also to show you how we do this valuation using discounted abnormal earning model, let's take up this simple example here. Assumption is your beginning equity is $100, okay, which is reported in the last year's financial statements. So you can observe now. Okay. We assume ROE is 12%, cost of equity 10%, and the dividend payout ratio is 50%, and all those ratios are constant. Okay. Now, when we get this kind of question, it's always a good idea to have a spreadsheet in front of you and write down those assumptions clearly. Okay. So think about the first year. Your beginning equity is $100, given from here. Your net income will be your ROE times the beginning equity. Okay, so again, I have to emphasize, the ROE we'll talk about here is the net income divided by beginning equity. In last week's slides, we simply use our net income divided by the ending equity. Okay? This is kind of different. In valuation, we use the beginning equity as a denominator. So use $100 times 12%, you get a net income, that is $12. And dividends is computed using the payout ratio, 50%. So 50% payout ratio means for every $1 of earnings, you pay half of that, which is 50 cents out as dividends. So if we have $12 of earnings, your dividends will be half of that, which is $6. Okay. Now you can also work out the ending equity. Okay. Use the beginning equity, okay, plus net income minus dividends. Okay. You get ending equity, which is 106. Okay. You can also work out abnormal earnings. Abnormal earning is your net income minus cost of equity times the beginning equity. Your net income is $12, okay, minus your cost of equity 10%, okay, times beginning equity 100. So that's 10. And then 12 minus 10 gives you $2 of normal earnings. So you work out these numbers for the first year. Now for the second year, okay, your beginning equity should be equal to your ending year equity in the previous year. So effectively move this number 106, okay, from end of year 1 to the beginning of year 2. Okay. Then again, use the beginning equity times ROE 12%, you get the net income for the second year. Okay. Divide this net income by half, you get a dividends for the second year. Then use the beginning equity plus net income minus dividends, you get any equity. Okay. Then use net income here, okay, minus 10% times the beginning equity, you get abnormal earnings. Okay. Then you do this year by year for the next few years. Now if you want to check the growth rate, okay, now for the beginning equity, from 100 to 106, the growth rate is 6%. Again, from year 2 to year 3, it's not 6%, it's always 6%. If you have the growth in net income, dividends, abnormal earning, it's always 6%. So that is consistent with what we said in the previous slides. If you can assume your ROE, cost of equity, payout ratio are constant, then all the numbers will grow at the same growth rate. And that is sustainable growth rate. Okay. In terms of valuation, very straightforward. Okay. Now here, because your dividends is growing at a constant rate, so we can directly use constant growth rate model to find the present value for this company. Okay. So that is D1 divided by R minus G. So D1 is the first year's dividends, $6. Divided by R minus G, 10% minus 6%, and that gives you $150 okay, for this company. If you want to use a discounted abnormal earning model, okay, so remember the equation here is the first component is the beginning book value of equity. You have to add that. Okay. So that's the beginning equity plus abnormal earning divided by I minus G, because abnormal earning should be ABU1. Okay. Okay. The first year's abnormal earning is $2, okay, divided by R minus G, 10% minus 6%, because the growth rate is also constant at 6% a year. And you also get this $150. Yeah. So the two models give you exactly the same valuation under this set of assumptions. Yeah. Now in the exam, what's going to happen is I will give you those assumptions. And then you need to find the right equation to do the calculation to find the valuation. All right? Any question here? If you want to use a abnormal earning model, you need to estimate discount rate. And you need to forecast ROE, dividends, and terminal value. But the advantage of this model is quite intuitive appealing. And more importantly, okay, this model has given much less impact on terminal value. Okay? Now in this example, what we see here is, okay, if you look at this valuation here, now out of this $150, $100 comes from your beginning equity, and $50 comes from your terminal value, or that is based on your long-term forecast. So about 2/3 of value for this company is driven by something we can observe, that is the beginning equity. You can see this number on the last year's balance sheet. Okay? So your forecast, your terminal value, will have a much less impact on your valuation if you use discounted abnormal earnings model. And this model also builds up the direct link between accounting performance, that is ROE, and the firm valuation. Okay, so we come to report high earnings, everything else equal, we just have high ROE. And high ROE just means high share price and high valuation. Right? So that's why we try to promote this model more. And it's kind of robust to bad accounting. Now in your textbook, that's a bit of an explanation why this happens. Okay? So that is what we have here. Let's take a break, okay, for about 10 minutes.
Okay, and for this one, you need to tell me what is that? Covering the down, and what is the, for example, in the cases for this for Walmart case, you say that the billing ratio is better than one, and that means the problem is what it means, and then you can get the change of time and do this percentage comparison. You say you listen to the lecture recording. Yeah. I thought this quite a big mic. Why is that very big? Because of the sound, right? Yes. That's right. It doesn't have too much of a syllable. Okay? So get a big number here. And why is it negative? You want to capture the negative. Numbers also big because you don't have too much of a capture. Even negative is negative. More negative number. So so this problem maybe too much is too much for us. What it does tell us is that company has a very small amount of negative in the company. And then it comes to that's why the conversion is going on. So this conversion is
All right, let's come back to the class. So just now we talk about this discounted cash flow approach. These models are long and they quite hard to apply. For all the models, if you want to use a model to do valuation, you have to forecast future earnings, cash flows, or dividends. You need to estimate the discount rate. Okay. Now there's a second approach to do valuation, which is simple and easy, and that is the relative valuation approach. In this approach, valuation is based on some price multiples, such as the P/E ratio. This is the share price divided by earnings per share. P/B ratio, the share price divided by book value of equity per share. And then some years people use the price to sale ratio. Okay? This is the price divided by sales per share. The simple idea underlying this relative valuation approach is if you have two companies, A and B, and they believe they are the same. Okay, the same risk, same operation, same products. Okay. If you find the company B has a P ratio of say 10, that basically means for every $1 of earning produced by company B, investors are willing to pay $10 for that. If you think if that happens, then company A's earnings should be priced in the same way. That also means for every $1 of a company A's earnings, investors should be willing to pay $10 for that. So if that happens, if you can forecast this company A's earning will be, say, $1.5 per share. Okay, then times 10, you completely get the price for company A, that is $15. So that's the approach we take here. So what you do is choose a benchmark P ratio or PB ratio. Then find your company's earning. Then use that PE ratio times your company's earning, you get the valuation for your company. So this is a simple and easy approach. Okay. Quickly to apply, low cost, you don't have to forecast, you don't need to do a lot of things, you can do that in just a few minutes. It's often used in IPO valuation or merger acquisition valuations. The reason is in IPO valuation, for those kind of companies, they don't have a long history for you to examine. They don't have a very certain features that can reliably forecast. No, these companies are very hard to predict, very hard to value. So instead of use discounted cash flow approach, which you have to rely on your forecast, people use price multiples to make a simple and easy valuation. Difficulty. How to find the right benchmark. As we said last week, seems every company is kind of different. Okay? Every company is kind of unique in the market. It's not easy to find the right benchmark. The problem is if you find a wrong benchmark, then you're going to get a wrong valuation as well. Okay? Like P ratio. Okay, to give an example, I think a few years ago, Facebook went to IPO. Okay, I think in 2012 or 2013. And they argue, okay, since I have IPO, then we are going to use a benchmark of Google as a benchmark. When Google went to IPO in 2004 or 2005, they get a P ratio of 100. So we deserve that 100 P ratio. So it's 100 times of this year's earning. You should give us valuation about $30 per share. Now the problem here is, are you exactly the same as Google? And also the situation market in 2004, when Google was listed, probably is different than the situation you have in 2014 or 12 when Facebook was listed. Okay. So again, in this case, that 100 valuation is very high, or you could argue it's too high. And what you see here is after the IPO, Facebook share price kept going down for 2 years. Okay. So if you choose a wrong benchmark, it's very likely to get a wrong valuation. Now, benchmark is always a big issue here. Okay. So we're going to talk about more how we choose this one. Not every go-to firm with poor performance. When company poor performance means you have a negative earnings. Then you cannot use P ratio. If your earnings is negative times 10, you get a negative price. Again, that doesn't make sense. Or if you have negative book value of equity, okay, that means company has more liabilities than assets. If that happens, again, you cannot use PB ratio. Okay? So you have to make sure company has positive earning or positive equity. And there's many other factors affecting the two ratios, okay, which make it hard to find the right benchmark. Now we'll start as P ratio. Okay? So this is the price divided by earning per share. The price typically is today's price, but earning could be different. You could use last year's earning, okay, to do the calculation for the benchmark. If you use last year's earning, that's called a trailing P ratio. Okay? You can use the forecast next year earning. You get this forward P ratio. Now research shows forward P ratio is more related to the future stock returns. Okay? That means it's better to use forward P ratio rather than historical trailing P ratio. Now how do you find a benchmark P ratio? You choose a company in the same industry, okay, with similar risk and growth rate. Industry is relatively easy to define, but those two numbers, risk and growth rate, okay, it's hard to measure. Okay, for company's risk, as we said, you could have dozens of measures for risk. Your textbook in finance asks you to use standard deviation of stock returns. Sometimes we use the semi-variance because you don't count those the upper potential. You only look at this downside risk. Okay? Sometimes you can use other more complicated ways to measure risk. Okay? And also you have this price risk, you have operation risk, you have a business risk, you have a political risk. So that is hard to pin down which risk we want to use. Also growth. This is not your historical growth, what happened in the past. This is expected growth. And everyone, again, could have different expectations. Okay? So all this makes things very complicated to find the right benchmark. Now in practice, what people do is instead of finding one comparable company, you find a few. Okay? Could be a dozen. And then you use average of those comparable companies as a benchmark to do the valuation. Now, in IPO valuation, for example, okay, what analysts try to do in predicting the IPO price is, again, find the average P ratio for the IPO cases in the recent past. Say, in the past 6 months, how many companies in this industry went to IPO, and what's the P ratio they get? Then they look at the average and use that as a benchmark to price the new IPO firm. In merger acquisition, same story. When you try to acquire a target company, you also need to offer a price. Okay? And also for a target company, they also need to provide a counter offer. Okay? And then the basis for both parties to put forward the offer and bid price is the benchmark P ratio, PB ratio. And that is usually based on the average P ratio in the historical merger acquisition transactions in the past or recent past. So average ratio has been used a lot in these cases. And in both IPO case and in the merger acquisition cases, there's a lot of negotiation going on between the issuing company and the major investors, or between the target company and acquiring companies. So this negotiation process will end up with a particular P ratio, benchmark ratio that both parties will be happy with. Then that will be chosen as the offer price. So that is what we do, use an average rather than a particular company. Now we use the P ratio to make sure your earning, okay, is reliable. Okay? You need to focus on those core earnings instead of those transitory special items or extraordinary items. So what drives P ratio? Now in the market, you see some company have very high P ratio, as high as 100. Some kind of P ratio could be very low, 3 or 4. There's a wide range of that. Okay? Now, if you have a P ratio of 5, suppose if you could increase the P ratio to 100, you can understand your market value would increase by 20 times. Now, another way to ask the question is why some companies have a high P ratio of 100, others have a P ratio as low as 4 or 5. Even for technology companies, if you look at Microsoft, okay, this is one of those large players in this industry. Okay? Now, about 2 or 3 years ago, Microsoft had a P ratio about 8. Compared with the P ratio of Google, about 80. That's 10 times difference. Okay? So what's the reason why they have different P ratios. To understand that, okay, we'll start going back to this simple equation. Assuming you have a constant growth rate and use this constant dividend model, your price equal to D1 divided by R minus G. Divide both sides by earning. Okay. On the left-hand side, you have a P ratio. On the right-hand side, you have this dividend payout ratio. Dividend divided by earning, that's a payout ratio. Then divide by R minus G. So again, most of the variation in P ratio driven by your discount rate and your growth rate. When you have a high growth rate, your P ratio will be high. And that's the one single determinant of P ratio. Okay. Again, compare Microsoft and Google. Okay. At least 2 or 3 years ago, Microsoft has been regarded as an old company, mature company, with relatively small or slow growth. Okay. Google has fast growth because keep investing in the new areas or new technology. Okay. Now again, we have very different growth rate. Okay. You're going to have a different P ratio. Okay. Second one, again, the risk. Okay. When you have high risk, you usually have a low P ratio and low price. Okay. So that is what we observe in the market. Now next one, PB ratio. This is price to book value of equity per share. Okay, what drives PB ratio? This is what I learned from the discounted earning model that we showed just now. So the 3 factors determine the PB ratio: ROE, your risk, and your growth rate. Okay. Now from here you can say both PE and PB ratio are driven by your risk and growth, okay, or the discount rate and the growth rate. But we say PB ratio is more volatile. Okay. PE ratio could range from 3 or 4 to 100, but for PB, it has a relatively small range. Okay. From 0.5, that is very low PB, to if you have a PB about 3 or 4, that's very high PB ratio. So you have a relatively small range. Why that happens? You can understand it this way. So PE basically equals PB times B over E. You can cancel out B as a book value of equity. Okay, so get PE. Now the first one is PB ratio. The second one, if you inverse that, that's going to be ROE. Okay? So ROE is a small number, on average 10%. Okay? So if you have PB of 2, for example, divided by a 10%, then your P ratio should be 20. Okay? So on average, okay, your PE ratio should be about 10 times as big as your PB ratio. And that's, again, is what I observe in the markets. Okay? The average PB ratio in the market, about 1.6 or 1.7. And the average PE ratio, 16 to 17. Okay? Again, in the long run, over time. Okay? So the difference, again, here, because long-term ROE is about 10%. Okay? So your PE ratio on average is about 10 times as high as a PB ratio. Okay? Now, in the markets, what's interesting is some people trying to make investment decisions based on P ratio and PB ratio. The simple idea here is when a company has very high PE or very high PB, that means for every $1 of earning or book value of equity, investors are willing to pay high price. Okay? And if you can use earnings and the book value of equity to capture a company's fundamental value, then that means relative fundamental value, the price are very high, or sometimes could be too high. Then if that happens, in the long run, the price should go down to come back to fundamental value. On the other hand, company with low P ratio and low PB ratio simply suggest relative to fundamental value, the price are low or too low. Then those companies could be undervalued. They're called value stocks. Okay? So in the long run, they should give you high returns when prices come up to the fundamental value. So that's a simple investment strategy based on P ratio and PB ratio. Now that has a very long history. Okay? Back about half a century ago, some investors are trying to follow that strategy to invest in share markets. The question, does that work? Okay? Can we simply use P ratio or PB ratio to make predictions and make money from markets? So in research, we can do that. We'll have historical data in the markets in the past half a century. Okay? So what we do here is at the beginning of the year, okay, we calculate the P ratio and PB ratio for every company in the market. And then we divided those companies into 5 groups. First, based on P ratio. Okay? If you have very high P ratio, you get the first group. If you have low P ratio, you get the bottom group. Same way we do that for PB ratio. Then we hold this company in each group for a year. Then we calculate the average return for each group. Okay? Then from there you can say the difference in the returns from company with different P ratio and PB ratio. Then we do this year by year for 40 years. Then we calculate the time series average, okay? And say, does that strategy work? The results are reported in this table. So in this, on the left-hand side, we divide companies based on P ratio at the beginning of the year, okay? From low P ratio to high P ratios. Okay? And then we hold the company for a year. We calculate the annual return from that holding periods. Then we do this year by year for 40 years. Then we report the average return from this time period. So for these groups, okay, for low P groups, the average P ratio is 7. And for this group, it's 31. And the loss group is losses. That means even if you report a loss, I'm still willing to pay money for you. That means very high P ratio. But you can take this as an outlier. Now, think about returns next year. Okay. For group 5, you get an annual return of 23%. For this group, about 12%. So this means low PE company or value stock do give you high returns in the following year. Then there's high PE companies. Now you use the same strategy, but now you use PB ratio as a way to control your portfolios. Okay? And if a low PB company give you a return next year as high as 24%, and a high PB company give you a return about 9% next year. And the difference is quite significant. Okay? Now for a manager or hedge fund manager in particular, okay, if you want to trade on PE or PB ratio, this is a very simple strategy. Okay? Now if you can short, okay, that means you can short sell. What you can do is, for example here, okay, first, okay, you borrow the shares for those high PB companies from other investors, from brokerage house, sell in the market. Okay. Then we sell gets cash. With the cash, you buy company with a low PB in this group. Okay. You hold it for a year. By the end of the year, this company you have a long position in will give you a return of 24%. Okay. Then you can sell those shares in the market at the end of the year, get the money, buy back the shares in this group. This just gives return 9%. You probably increase 9%. Okay? They return the shares to the lenders. Your net profit or net return strategy would be the difference between this and this. That's about 15%. Now in this case, it's called arbitrage returns. You don't actually use too much of your own capital. But simply for this strategy, you get a 15% return a year, which is not bad. Okay? So this is a simple way to arbitrage in the market. Now you may want to ask, can we combine both P ratio and PB ratio? Can we get a high return from the combination of those two ratios? The answer is yes, you can. Okay, so first we sort the company into 5 PB groups. Then within each PB group, we further sort into 5 PE groups. So this group here has very high PE and a very high PB ratio. But next year, the return is only 4%. And this group has a very low PE and a very low PB ratio. And next year you get 30% returns. The hedge return, that is, have a long position in this group and a short position in this group, that will give a return of 26%, which is significantly high than the 22% Warren Buffett's return. Now, for most of the investors, especially for those hedge fund managers, if you see this table, you will be excited. Simple to make money. For researchers, what we are interested in is why this happens. Okay. Why can't investor arbitrage? Okay. Because a simple trading strategy everyone can follow. And actually, in the US nowadays, you actually get an index funds for the value company and for the growth company, the two sales. You can simply buy one index, short sell the other index, You can arbitrage yourself. Now, why arbitragers did not remove or eliminate this phenomenon, or what's the underlying reason for this? Okay. So, the two arguments here why this could happen. One is mispricing, as we just explained. Company in this cell with low P or low PB could have priced too low. They are undervalued. Okay? Investors don't like this company, they push down the price too much. And the company in this cell could be overvalued. So next year, price will converge fundamental value. That's why I say the returns. Another argument is the risk. Okay? Company in this components, in this cell, could be too risky, or they have high risk. And company in this cell could have low risk. Now we have high risk, you should give us high returns. Okay? We have low risk, yes, you can have low returns. So the high return from this low PE and low PB company is simply a compensation for the high risk. So in academic, we still have that debate going on, which explanation could explain what's going on here. But now, if you're interested in doing a PhD or honors degree, now you're welcome to pursue that debate. But for investors, no, that's probably enough for you to make money in the share market. Okay, so that's all we have for the lecture. That's not the end of it. Okay. We have some valuation questions, and we are going to go through that to help you with your final exam. Okay. I would strongly encourage you to stay and listen to the explanations. Okay. You could, I think you could get more marks in your final exam if you stay for another 30 minutes. Okay. But if you want to leave, it's up to you. All right, so if you have a computer or any kind of a pad or phone in front of you, okay, please open this document on Blackboard. Okay, if you have printed out, that's good. Okay. So this gives you 7 valuation questions. Okay. You will be given assumptions, and what you do is calculate or forecast the dividends of normal earnings, and then estimate company's fundamental value. In the final exam, you are going to say some similar questions. Okay, so you will again be given the assumptions, and you need to make the calculations. Okay. So what I'm going to do is I need to give you some time to read through questions at least, or even better, you need to think and work on those questions before I give you solutions. So let me give you about 10 minutes to just read through the questions. And also try your best to work on those questions. You don't have to get a right answer, but you need to get a bit of a practice so you know what's going on when we discuss those questions later on. Now, you don't have to copy those questions. It's on Blackboard. All right, for time constraint, we have to look at these questions together. Now, my suggestion is when I talk about those questions, you try to listen to me and understand the logic of this analysis. But after class, please do those questions by yourself first before you look at the solutions on Blackboard. Okay? That's the best way for you to learn from these questions. So we have a few questions here. The first one is, assume you expect a company's net income to remain stable at 1,100 for all the future years. So net income will be no change. Okay. And you expect all the earnings to be distributed to shareholders at the end of each year. Now in this case, all the earnings will be given out as dividends. So dividends will be equal to the earnings, that is 1,100 every year. Okay. So the common equity will remain stable as well. Okay. And they also assume company beta is 1.5, and the market risk premium 4%, and the risk-free rate is 5%. Now based on that, you can use CPM model, the capital asset pricing model, which you learn in your finance course to estimate the cost of equity, which is 11%. Okay. So that is RE we are going to use for calculation. Question B, compute the expected net distribution to shareholders, that's the dividends. As also just now, it's going to be the same as earnings, $1,100 per year for each year. And then use the discounted dividend model to find its price. Now in this case, your dividends will be the same every year. That means there's no growth, or the growth rate is 0 every year. And then you can use constant growth rate model to calculate the value. Okay? And there's the assumption that 0 growth rate. Okay? So question 1 is very simple, right? Okay? So the value equal to your D1 divided by R minus G. Okay? Yeah, I think you can say that. So D1 is the same as your earning, which is 1,100. Divided by R minus G. R is 11%, G is 0%. Okay? And you can get the answer very quickly. So that's going to be $10,000. Divide this number by 1,000 shares, so the share price should be $10 per share. So that's simple and easy. Okay? Now, question 2. Now here we're going to introduce some kind of a growth. Okay. Same fact as Q1, except you expect the company's net income will be 1,100 for the coming year or in year 1. And then it will grow at a rate of 5% in every subsequent years. So you have 5% growth forever for net income. Okay. And also assume company's common equity at the end of the most recent fiscal year is 80,000. In other words, you can think of this beginning equity at the beginning of first year is 80,000. Okay. And you also assume this beginning equity will also grow by 5% forever. Okay. And then you need to, and the company has no debt. Okay. So you are going to they are going to compute the dividends for the coming years and use valuation to do this. Now we have this kind of question. It's always a good idea to write down the cash flows. How does cash flow look like? Okay? Or the earnings. Okay? So you have a year 1, 2, 3, and 4. Okay? And what we know is you have a net income with an assumption for the first year that is going to be 1,100. And we know this will grow by 5% in all the future years. So for year 2, this will increase by 5%. Okay. And in year 3, that will increase by another 5%. Okay, so raised to the power 2. You can do this for year 4 as well. So that's the first assumption we know. The second assumption is the beginning equity. So the equity at the beginning of year 1, with assumption is $80,000. And we know, again, this number will increase by 5% forever. So in year 2, your beginning equity will be 80,000 times 1.05. In year 3, it's another 80,000 times 1.05 raised to the power of 2. Okay. Now, what we don't know is any equity. There's no assumption of any equity. But we know this year's ending equity must be the same as next year's beginning equity. Okay? So effectively, just move this B0 for the next year down, so you get the ending equity for the previous year. So that will be 80,000 times 1.05. We do that for the year 2 as well. Okay, it's another one. Probably gets this. So that is what we know from the assumptions. Now I need to find the dividends. Okay. So how do we find dividends based on those assumptions? And remember in the class, there's one slide showing if clean surplus equation holds, your ending equity equals your beginning equity plus net income minus dividends. If you move dividends to the left-hand side, move the ending equity to the right-hand side, you get an equation for the dividends. Okay? Your dividends equal to your net income plus beginning equity minus your ending equity. Okay? So we'll get the three numbers. Okay? Use your net income plus beginning equity minus ending equity. You'll get dividends. You do this calculation, you get dividends for year 1, 700, for year 2, 735, and for year 4, year 3, 771.75. If you check the growth rate, from year 1 to year 2, that's 5% growth. From year 2 to year 3, that's another 5% growth. Whereas it may not be surprising because if you look at the equation here, all the net income B0 and B1 all increase by 5% a year. So the dividend must increase by 5% a year as well. And now once you figure that out, you can quickly find out its valuation. Okay? So we'll put it down here. Okay? Your valuation on the question 2 should be your D1, 700, divided by R minus G. R is 11%, the cost of equity. G is the growth rate. In this case, it's 5%, because we know your dividend will increase by 5% a year as well, for every year. Okay? And then you will get a valuation of so this is how we work out the dividends. Now this is just one way to work out dividends. Based on assumption, if you give different assumptions, you could work out dividends in a different way. Okay? So that is question 2. Now question 3. Same facts as question 2, but your 5% income or growth rate in income and net income on the beginning of equity will only happen for year 2 and year 3. After that, there's no growth. Okay? So that's kind of a changing assumption. We're going to play with that. So what we see here, we use kind of different color of pen for the cash flow. So you have 5% increase for net income for year 2 and year 3. And in year 4 onwards, there's no growth. For year 4, your net income will be the same as year 3. Similarly, your beginning equity will also increase for year 2 and year 3 at a 5% growth rate, but in year 4, there's no growth. Okay? So year 4's equity will be the same as year 3's beginning equity. Now, once you write this down, okay, for any equity, again, you move this one here, move this one here. You also need to move this one down here. So this number, okay, will change from 3 to 2. Okay. Now, for year 4, if you're going forward, there's no change. Okay. So if you think about year 5, put year 5 somewhere on this side, but it's again the same as year 4. So your any equity for year 4 will be the same, okay, as the beginning equity. There's no change. Okay. Now you can work out dividends. Okay. So for year 1, again, 700, no change. Year 2, 735, no change. But in year 3, you use net income plus beginning equity minus equity, you get a big number. And that is because there's no change in the equity actually starting from year 3. Okay. And this number will be the same as year 4 as well. Okay. Then again, you can realize starting from year 3, your growth rate in dividends will be 0. Okay. Again, it's constant. Okay. So you can use the valuation to find this cash flow valuation. So you have first 2 dividends which have 5% growth. Okay? But starting from year 3, you have 0% growth. So you can use multiple periods model to find valuation. What we do is discount the first dividends for 1 year, discount the second dividend for 2 years, then find the terminal value, then discount terminal value, then find the present value. Okay? So you discount the first one, D1 for 1 year. Okay? Discount the second one for 2 years. Okay. Then find the terminal value. Okay. Terminal value is negative dividends D1 divided by R minus G. So that will be D3 here. Divided by R minus G. R again is 11%. G is 0%. Okay. Now remember, when we calculate this terminal value, it's at the end of year 2, okay? 1 year before your D3 here. Okay? So it's going to be the present value here. Okay? You need to discount this number again for 2 years. Okay? I emphasize this one, use 2. It's not 3. Okay? Then this will give you a valuation of all right. Okay. Now, question 4. Same facts question 3, except the growth rate of 5% for year 2 and year 3, then 3% forever. Okay. So in this case, there's a little bit change in the growth rate. So I have 5% for year 2 and year 3. And starting from year 4, there could be 3% growth. So for year 3, this will be increased by 3%. Your equity was increased by 3%. And again, you need to move this new equity number to the previous year, okay, to get the any equity. So they increase by 3%, and this will increase by, okay. Excuse me. So once you have this pattern, again, use the same formula we show here, okay, to find the dividends. Okay. So D1 will be the same, D2 will be the same, D3 would be different. Use net income plus B0 minus your any equity. Any equity now increased by 3%, okay? Because your beginning equity next year will increase by 3%. So that will be okay, the same calculation for year 4, you find that will be 97. Okay, in terms of a growth rate, from year 1 to year 2, 5% growth. There's a big jump from year 2 to year 3. Now, if you look at year 3 to year 4, that's about 3% growth. Okay? And again, if you do year 5, another 3% growth. So again, starting from year 3, dividends will grow at 3% per year forever. So again, we use constant growth rate model to find the terminal value and do the calculation. Okay? So for question 4, your value would be 700 divided, discounted for 1 year, 735 discounted for 2 years, plus the terminal value. Okay, then that will be 948.15. That's a D3 divided by R minus G, R 11%, G is 3%. Okay. Again, you need to discount this number for 2 years. And this will give you a valuation of right. Now, before we move on, just quick words. So as I said in the class, a key determinant of your share price valuation is the growth rate. We have high growth rate, you could have a higher valuation, high share price. In this question, we keep the discount rate constant at 11%. We just change your growth rate. So if you start at question 1 here, this is a base case. There's no growth. So you have $10,000 for the firm value. In the second question, you have a 5% growth forever. So your valuation increased by about 16.7%, okay, with 5% growth. Now, question 3 basically is a short-term growth. Yeah, 5% growth, but only for 2 years, year 2 and year 3. After that, there's no growth. And what you see here is that your valuation relative to the base case increased only by about 1.7%. Okay? Now, in the third case, you have a 5% growth for 2 years, okay? But you have a 3% growth forever. So long-term growth decreased from 5% in the second case to 3%. And your valuation, okay, will decrease from 60% increase to about 8.5% increase. So long-term growth rate is a key driver of a company's valuation. The short-term growth, okay, does not have too much effect, okay, under this discount dividend model. Okay, so that is what we get from a simple question. The next one is using the same assumption as question 2. Question 2 is 5% growth, okay, forever. Okay? Excuse me. But we use abnormal earning model or residual income model. Okay? So first you need to understand what is this residual income model. Okay? Your abnormal earning, this equals your net income minus cost of equity times beginning equity. Okay? So that's the equation you need to memorize. Okay? Another way to write this down is this is ROE, okay, minus R times B0. But ROE here is your net income divided by beginning equity, not ending equity. Okay? So once you get the equation, you can work out the abnormal earning using the first equation. Okay? That is your net income here, 1,100 times beginning equity, 80,000, minus beginning equity times 10% or 11% the cost of equity. Okay? So use net income minus 11% cost of equity times beginning equity. You can work out the abnormal earning. For the first year, that is 220. For the second year, okay, 5% growth in net income and beginning equity. You get net abnormally about 231. Okay, and you do that for the year 3 as well. Another 5% growth. You get 2. Okay. Now, if you check the growth rate from year 1 to year 2, that's 5% growth. Year 2 to year 3, another 5% growth. If you do year 4, again, it's going to be 5% growth because both net income and the beginning equity grow by 5%. So the difference will also increase by 5%. Okay. Now, once you have that, to calculate the valuation, okay, so remember this equal to your beginning equity plus the present value of normal earnings. Okay. So this equals to your beginning equity, 8,000 plus. Now your beginning equity is growing by 5% every year, so you can use constant growth model to find the present value. Okay, that's 220, the first year of normal earning, divided by R minus G. R is 11%, G is 5%. Okay. And this will give a valuation of the same as the discount dividend model in question 2. Now the question 6 asks you to use assumption in question 4 to reduce this calculation. So question 4 is 5% growth for year 2 and year 3, then 6% growth forever. Okay. So again, now what you do is you work out those net income, beginning equity, using the same formula to calculate normal earning. Use the same approach to work out the valuation. Okay, so I'm not going to go through that. Okay, you can do it after class as an exercise. We also have a question 7. Okay, ask you to use this formula. That is ROE minus RE. Okay, times beginning equity. Okay. Now again, this is these two equations here are essentially the same. Okay, but just remember, you use the beginning equity to calculate ROE. They will get exactly the same normal earning, and you should also get exactly the same answer. Okay. So this is what you should do to do valuation questions. Now in the exam, the question will be very similar to what you see here. I will give you all the assumptions. You don't need to make any new assumptions. Okay. Then just need to do a calculation. And it's always a good idea to write down the cash flow patterns year by year, and then find the given information or assumptions, work out your dividends or normal earnings or free cash flows. Then you can work out the valuation. All right? So that's all I have, and thank you very much. I'll see you later.
It's not actually just you need to. So that's why we do a calculation for you. The market risk premium is 4%. This is market risk premium. That's 4%. This is second market risk premium. That's not market risk premium. So this is already 4%. That is premium. Question 4 is 5 centers, 5 centers, and 3 centers. So that's substitution of system in year 4.
Right. Okay. I get it. Thank you.
Return earnings. No. No, any equity equals the beginning equity plus return earnings. And return earnings is the net income minus dividends. That's what you learned in the first class in accounting.
Is it retained earnings?
Return earnings.
Okay. So your book value equity. So it only includes this. Doesn't include the share capital.
Your share capital to the beginning equity, right? So think about this. You have when you begin, you have equity at the beginning of the year that's coming from your accumulated return earnings in previous years, share capital, everything here. Now this year you operate, and you have profit, you pay dividends, and then you have a return earnings that goes added to this equity, and that's how you get this ending equity.
Okay.
Right? So this any equity still have paid in capital 10 years ago. Still there. So what you have here, this equation here, this is not right. Okay? What you should write is change in beginning equity is return earnings. Yes, that will be there. So in this case you need to calculate. Okay, so use net income, what you see here, this is your function get, divided by the beginning equity. That's the way to get the ROE.
That's what we learned about the adjustments, right? Then I was looking through the text. Operating and finance lease, right? They actually define the internal rate of return so that we can calculate it with the operating lease.
Yes?
But how do you actually get this IR? Because don't we have to use Excel to
Oh no. Even then will be different.
Okay.
Okay? No, I cannot allow you to have different boxes. Right, do you have a question? If any of your friends that do accounting, maybe you ask them.
I'm doing accounting now. But what I know is equity comprised of share capital, retained earnings, etc.
Yeah, that's right.
So this book value equity does not refer to equity itself, is it?
It's the same.
It's the same.
Yes?
Okay, so that's why it does not refer to just retained earnings.
So what we're talking about here is, again, think about your beginning, your any equity. How do you get any equity?
Any equity?
Right, at the end of this year. That's coming from the beginning of the year, plus the return earnings. If you have any change in shareholder capital, it goes there as well.
It goes to where? To the change of share capital.
So if you issue new shares, buy back the shares, that goes there as well. Okay. Now here in this question, we assume those kind of transactions will not happen.
Okay.
The only change in this equity is due to return earnings and nothing else.
Okay.
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 Right, so that's what we call